Just this past week, we were on conference calls with 3 of our top high net worth strategists, and all 3 of them believe that the conditions right now are very favorable for falling into recession, for the United States economy to fall into recession sometime in the second or third quarter of 2023. As a result, it is important that you prepare yourself for this very real possibility. So what can you do to prepare? Well, there are a few things that we've been discussing with our clients, a few strategies that we're employing right now to help prepare our clients for a recession and what would also be a little mini market decline. All right, the market has never hit a low point prior to a recession. The market usually hits its low point during the recession, however, begins to rebound before the recession is over. So how can you shield yourself from the recession that is likely coming? Well, number one, you're going to have some cash on the sidelines. Many of our clients, we've been talking about, let's beef up our emergency funds, let's have some cash in the bank, but let's also have a little bit of extra cash in our portfolios. Ordinarily, we might have cash balances of 2, 3, maybe 4%. However, right now, depending upon the risk appetite for each client, we're looking at cash balances somewhere in the range of 5, maybe 10% of their total. We're not holding cash because we're afraid. We're holding cash because we want to have some dry gunpowder on the sidelines when a buying opportunity presents itself sometime later this year. Rather than just having straight up cash, because cash is great. It's great to have cash on the sidelines to buy, but it doesn't really do much for you. So while you're sitting on your cash and you still want it to do something for you, earn some money, we've been talking to many of our clients about perhaps a short-term laddered U.S. Treasury strategy. For us, with as little as $25,000, we can put together a laddered Treasury bond strategy made up of 5 different U.S. Treasury bonds, ranging from 3 months in length to 15 months. And right now, that is yielding 4%. That's paying an income of 4%. Last week on the show, we shared one way to take advantage of rising interest rates. Bond coupon rates are much better right now. So this laddered U.S. Treasury strategy is yielding 4%. Number 2, protect some money now. So you have probably seen your investment accounts recover a little bit of what they lost last year. If you've got a moderate risk profile, a moderate risk appetite, the market was down about 20% last year, so maybe you were down somewhere in the range of 10 to 12%. And here at the beginning of the year, the market's up about 8%, so maybe you've recovered 4, 5%. And you feel good about that. You like to see those numbers going up. However, the market's probably going to give a lot of that growth, if not all of it, back. So if you're looking to maybe harvest some of those gains before it's too late, maybe you want to pull some of that money off the table, or if you've got some cash sitting on the sidelines that you don't really need, maybe you can protect some of that now. You can share in market growth, but you do not share in market losses. So when the market gains, you share in a portion of that. But when the market goes negative, you do not share in any portion of the loss. All of your gains are locked in. So right now, what can you get if you decide to protect? Well, how about an 8% bonus on the money that you put in? And that bonus is in effect for 7 years when you put new money in. You can add money to it, and every time you do, for 7 years, you're going to get 8% bonus on that money. So for example, let's say you start off by protecting $250,000 off the top. You got $1 million, you want to protect 25% of your money? Take $250,000, put it inside of this protected account. That $250,000 would instantly become $270,000. And then you begin earning interest on top of that. Or how about this? Maybe you want to protect your money and you want to focus more on income as opposed to growth. How about a 32% bonus on the income bucket? So again, if you protected that same $250,000, there's a separate bucket that's attached to that that's specifically for income. You can't pull it all out, but you can turn it on for income later on. Well, your $250,000 becomes $330,000, and if that bucket continues to grow over time so that later on when you turn it on for income, if you wait long enough, you could have a bucket that's $500,000 in value that now serves as a completely new stream of income for you in addition to your investments in the stock market or your pension or your Social Security or maybe a business that you own, minerals, things like that.